our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. We do hear a lot about affordability, and we take that very seriously, and we take it to heart, because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control, and frankly, to finish the job of getting inflation back down to 2%.
Consumers you've heard the word choiceful, which means they're trading down. How will this impact earnings with stocks near all-time highs? And when I say all-time highs, the Dow is nearing 50,000. The S&P, as we said, already crossed 7,000. Is it time for investors to go from sanguine to more serious, or keep rolling with the momentum tape? Knowing what we know from the Fed right now, joining me now, UBS Managing Director and Senior Portfolio Manager Jason Katz, and J.P. Morgan Asset Management Global Market Strategist Meera Pandit. Okay, Jason, how is this going to affect earnings if what the Fed sees is a slightly slowing consumer?
I think, we're looking at earnings that are going to go 10, maybe 15% higher this year.
That's awesome, isn't it?
Yeah. I mean, we're going from the application, or rather the enabling stage, to the application stage of AI. That's going to power it. Knowing that interest rates are going lower, maybe not tomorrow, perhaps in the summer, that too will empower the consumer. So I think that earnings are going to go up, and the cyclical parts of this market, the average Joe stocks, are going to fare very well.
Average Joe stocks, what do you mean by that? What sectors?
I mean, the real economy, things you could touch and you could feel, the cyclical stocks. It could be energy, it could be industrials, it could be materials. The S&P 493 is going to grow earnings around 10%, and yet they're at 2/3 the multiple of the Mag 7. So I'm very bullish on the economy, modestly bullish on the S&P, but beneath the surface, there's ample opportunity.
Meera, you are the global market strategist over there at J.P. Morgan. So globally, let's sort of expand the picture here. Do you stay with what is a couple of markets that are getting very close once again to records here in the United States, or do you expand out knowing that the Federal Reserve right now is in a pause mode?
If we think about what we had heard in terms of that broadening out beyond tech to some of the cyclicals, the more value-oriented sectors within the market, that's something we're also seeing internationally. You're seeing that international value segment outperforming quite handily, because if you think about it, everyone's doing the bread and butter. The U.S. continues to do their bread and butter, the technology. You think about Europe, Japan, it's banks, it's industrials, it's around some of those defensive stocks, very much playing into some of the trends going on overseas with that higher fiscal spend in Japan, that higher fiscal spend you see in Europe. So certainly that broadening out has benefited investors when they're thinking about the underlying assets abroad. And you continue to see that weakening dollar trend this year. And all of that put together means the U.S., while still doing reasonably well this year, is at the bottom of the leaderboard when we compare to other international regions.
Let's be clear about the dollar. That is definitely a story. Yesterday, it dropped to a 4-year low. Right now, it is mixed against the major currencies. But last night, President Trump basically said the dollar is great. The dollar is doing great. And he said, let it seek its own level. But today, Scott Bessent, the Treasury Secretary, came out and reiterated and touted the administration's stance, which he said was for a strong dollar. Let's just say that at the moment, people are nervous about the U.S. and they want to go elsewhere. You like Japan, and when you compare exactly how the Nikkei 225, which is their version of the S&P or the Dow 30, how that has performed against the S&P year to date, it's pretty impressive for the Nikkei. Is there still more room to run?
From a Japanese perspective, yes. We think yes because...
How about a U.S. investor looking?
I think so still, because, again, we really want to think about some of the underlying fundamentals and the drivers there outside of just the currency story. Think about the corporate reform going on in Japan and that idea that we need to deliver for shareholders, whether they are domestic or abroad. That's been a multi-year story where we continue to see the benefits come through, and it's contagious. You're starting to see that in Korea. You're starting to see that in Singapore. So that's starting to crop up in other markets to attract that domestic and foreign investment.
The Kospi, South Korea, just recently popped above 5,000 for the very first time. Over the past 6 months, it too has well outperformed the S&P 500. What's going on that investors globally are saying, let me try some of these other countries and invest there?
one of the best performing markets last year, really strong markets so far this year. You see some areas of Latin America doing well, but Korea, again, doing pretty well here, too. It's partly a story of, again, some of that corporate shareholder reform that is extending out, but it's also part of that AI story when we think about North Asia in particular and how it is benefiting from the globalization of AI and the increasing global competition around that theme. It is definitely a big U.S. theme, but there are certainly opportunities to play that theme outside of the U.S. as well.
Jason, what did you hear today that altered anything about your investment path for your high net worth clients?
Really nothing. We always on Fed Day talk about the most anticipated meeting. This was, as Jeremy Siegel said, a nothing burger, and with good reason. I mean, they need to see these 3 previous rate cuts take hold. And so I don't think the narrative changes for investors. I think, to her point, we need to look beyond just the school of what's worked over the last few years. You need to look internationally, value, cyclical, small and mid cap. Now's the time to spread risk out and not just have it in a concentrated portfolio.
Okay, but if you look at gold and silver, I stole your line earlier. You said it's starting to really look like a meme trade. But is it? This has been going on for the gold more than a year, and the silver trade has just been, I mean, it's gone parabolic.
If I told you how many emails and calls I get about silver and I get about gold, it's so reminiscent of all the other bubblicious periods
Well, what are
we've
they
been
saying?
through.
Are we in gold? Are you buying me gold bars? Are you buying me silver?
I mean, verbatim, that's what they're saying. So if you look at the flows in ETFs,
And are you?
look, in the GLD, that ETF, almost 90% of the flows have been retail oriented. When that happens, I have to take a step back and pause. There's good reasons why gold should be going up, but now it's been, as I said, and you stole the line, memified. I would take a pause before entering.
Okay, and Meera, when you look at the possibilities for a bump in U.S. equities this year, we've got the big, beautiful bill that passed into law, and there are going to be tax returns that may be inflated, certainly, looking better for people. They'll get more money. Do you think they take that and put it into stocks, and if so, where?
I think they take that and put that right back into the economy in terms of spending. Whether that goes necessarily to stocks specifically, I don't know. But I would say that the lower and middle income consumer is primed and ready to spend and boost that overall GDP. So I think that the big impact from the One Big Beautiful Bill Act is around a boost in the consumer. So it's not just that K-shaped economy of the upper income consumer, but rather spending across the board, at least for the first half of the year. And then I also think you start to see businesses take advantage of the 100% depreciation, bonus depreciation, the accelerated R&D scheduling as well. And I think that's part of the reason why you see, again, that more of that cyclical rally this year when you think about energy, materials, industrials, because some of these capital-intensive businesses are starting to take advantage of pushing that tax liability to the future and investing today.
Meera and Jason. Yeah, I hate to say nothing burger like Professor Siegel did, but fence sitting, the market is really not doing a lot right now, but thank you for bringing a lot to the table now. Appreciate it.